Before we dive in, it is crucial to understand that this video is for informational and educational purposes only. I am not a financial advisor, and the content presented here should not be construed as financial, legal, or tax advice. Life insurance is a complex financial product, and your individual situation is unique. Please consult with a qualified and licensed professional before making any financial decisions. Your financial future is your responsibility. Dave Ramsey's most famous piece of financial advice could be a trap. There, I said it. For millions of Americans, the mantra "buy term and invest the difference" is gospel. It's simple, it's powerful, and for many people, it's absolutely the right move. But what if you're not one of them? What if that simple advice, followed blindly, leads you straight to a financial cliff on your 65th birthday? Picture this: you're 35 years old. You and your spouse have 2 young kids, a mortgage, and big dreams for the future. You do the responsible thing. You listen to the country's most trusted financial radio host, you call an insurance agent, and you buy a 30-year, $1 million term life insurance policy. Cheap, maybe $50-$60 a month. You feel a wave of relief wash over you. Your family is protected. You've checked the box. You diligently follow the rest of the plan, attacking your debt and investing every spare dollar you can into your 401k and mutual funds. Life happens. The market goes up, the market goes down. You have a few great years, a few lean years. You pay for college tuitions that cost more than your first house. You help with a wedding. You navigate a recession or two. Now fast forward. You're 65. You get a letter in the mail. It's not junk mail. It's a notification that your life insurance policy, that bedrock safety net you've had for 3 decades, is expiring. You take a deep breath and look at your retirement accounts. They're good, they're healthy, but maybe not quite as big as the online calculators projected. You're not quite at that magical self-insured finish line. Your spouse is still alive, and you still want to leave something behind for the kids, for the grandkids. You still have financial obligations. So you pick up the phone to get a new policy. Just something to cover final expenses and leave a nice legacy. And the agent on the other end of the line quotes you a price that makes your jaw hit the floor. $800 a month. $1,000. Maybe more. Or worse, because of that minor heart issue you developed in your 50s, or the diabetes diagnosis that came out of nowhere, they tell you you're completely uninsurable. At any price, the safety net is gone. And you're standing there, at the one time in your life you can't afford a major financial mistake, completely exposed. This isn't a scare tactic. This is a reality for a growing number of people who followed the most popular financial advice in America to the letter, only to find out it had a hidden expiration date on their peace of mind. This is precisely why we're making this video. We are going to rip the cover off the entire life insurance debate. We will break down exactly what Dave Ramsey's philosophy is, why it's so incredibly popular, and for whom it works perfectly. We'll give him all the credit he deserves, because his advice has genuinely helped millions of people get out of debt and build a solid foundation for wealth. But then we're going to do what most financial entertainers don't. We're going to explore the gray areas. We're going to talk about the people the Ramsey plan leaves behind, the business owners who need to fund a buy-sell agreement, the high-net-worth individuals trying to mitigate estate taxes, the families with special needs children who will require lifelong care. And maybe most importantly, we're going to talk about anyone who wants to use life insurance not just as a temporary shield, but as a powerful multi-generational wealth-building and tax-saving tool. By the end of this presentation, you will understand the critical differences between term and permanent life insurance, not as a sales pitch, but as a strategic choice. You will know the right questions to ask, and you'll be able to spot the flawed logic in the one-size-fits-all arguments, so you can build a financial plan that protects your family for life, not just for a term. First, let's give credit where it's due and dive deep into the Ramsey philosophy, because to understand its limitations, you first have to appreciate its brilliance. Dave's argument is built on a single, powerful premise. The only purpose of life insurance is to replace your income for your dependents until they no longer need it. That's it. It is not an investment. It is not a savings account. It is not a lottery ticket for your family. It is a utility. Like your car insurance or your home insurance, you pay for it hoping you never have to use it. And since its only job is to cover a temporary problem, the years when your kids are young and your mortgage is big, you should buy the cheapest possible product that gets the job done for that specific period. That product is term life insurance. The second part of his mantra is the engine. Invest the difference. The logic is simple. A term policy for a healthy 30-year-old might cost $50 a month. A comparable whole life policy, a type of permanent insurance, might cost $500 a month. Dave's argument is to take that $450 difference and invest it aggressively in good growth stock mutual funds. Over 30 years, thanks to the magic of compound interest, that $450 a month is supposed to grow into a massive nest egg. $1 million, maybe more. By the time your 30-year term policy expires, you will have no debt, not even a mortgage, and you'll have such a huge pile of money that you have become self-insured. If you pass away, your spouse can live comfortably off the investments. You no longer need life insurance because you've essentially become your own insurance company. And let's be crystal clear. For a huge portion of the American population, this is solid, effective, and beautifully simple advice. If your primary financial goals are to pay off your house, raise your kids, and retire with a decent nest egg, this plan works. It's a straight line from A to B. It removes complexity and focuses on disciplined saving and investing, which is where most people fail. The problem isn't that the advice is bad. The problem is that it's presented as the only solution, a universal truth that applies to everyone, in every situation all the time. And that's where the danger lies. Finance is personal, and a one-size-fits-all t-shirt rarely fits anyone perfectly. The entire buy term and invest the difference strategy hinges on three massive assumptions. Assumption 1, that you will have the discipline to actually invest the difference every single month for 30 straight years without fail. Assumption 2, that the stock market will provide the consistent, high returns needed to build that giant nest egg. And Assumption 3, that your life will proceed in a straight, predictable line, with no major financial catastrophes, health crises, or family situations that derail the plan. But what if you're not the average person the plan is designed for? What if you're a high-income earner who already maxes out your 401k and Roth IRA every single year, and you're looking for another place to put your money that can grow tax-deferred? What if you're a successful business owner, and you and your partner have a buy-sell agreement to ensure the business can continue if one of you passes away? Using term insurance for that is like playing Russian roulette. If a partner dies after the term expires, the entire business could be destroyed. What if you want to leave a guaranteed, 100% tax-free inheritance to your children or a charity, a legacy that isn't dependent on the whims of the stock market? A term policy can't do that. It's designed to disappear. This is where the conversation needs to shift from a simple either/or to a more sophisticated look at financial tools. Term insurance is a hammer. It's great for nails, but sometimes you need a screwdriver or a wrench or a laser-guided saw. Permanent life insurance, like whole life or universal life, is the multi-tool. It's more complex, it's more expensive upfront, but it does things a hammer could never do. The critics, including Ramsey, will tell you these products are a ripoff, loaded with high fees and pushed by greedy salespeople. And sometimes they are. But when used correctly for the right person, they offer benefits that are simply unattainable anywhere else. They offer a guaranteed death benefit that will never expire. They build a cash value that grows tax-deferred, that you can borrow against tax-free, and that is protected from creditors and lawsuits in many states. It becomes a financial fortress, a private bank, a source of liquidity that exists completely outside of Wall Street. It's not an investment in the same way a stock is. It's an asset class all its own. So, is term life always the best? The simple answer is no. The real answer is much more interesting. And over the course of this video, we're going to arm you with the knowledge to decide for yourself. We will cut through the sales pitches and the radio soundbites to build a fortress around your family's future that actually works for your life, not a generic formula from someone else's. We're about to explore the world beyond the basics, and it starts with understanding what you're truly trying to accomplish with your money. So let's start right there. What are you truly trying to accomplish? For most of us, the answer is simple: security. We want to know that if the worst happens, the people we love will be okay. They won't lose the house. The kids can still go to college. The lights will stay on. It's a foundational, primal need. And this is exactly where Dave Ramsey's advice begins, and why it's so powerful. To understand his philosophy on life insurance, you have to understand his entire system. The baby steps. It's a plan designed for people who are financially drowning. People buried in credit card debt, student loans, and car payments, living paycheck to paycheck, feeling utterly hopeless. His message is a financial life raft. It's simple, it's direct, and it cuts through the noise and complexity that paralyzes most people. He tells you, do this, then this, then this. Don't deviate. Don't overthink it. For millions, this has been a godsend. Within this system, his view on life insurance is perfectly logical. He sees life insurance as a tool with one, and only one job: to replace your income for your dependents until they no longer need it. That's it. It's not an investment. It's not a savings account. It's not a magic money machine. It is pure, unadulterated risk management. A safety net. His ultimate goal for you isn't to have life insurance forever. His goal is for you to become what he calls self-insured. This is a critical concept. Being self-insured means you've paid off all your debt, including your house, and you've built up such a massive pile of investments, your nest egg, that if you were to die, your family could simply live off the interest and earnings from that pile of money. They wouldn't need a life insurance check because you've essentially become your own insurance company. Your wealth itself is the safety net. So, if the goal is to eventually not need life insurance, why would you buy a policy designed to last your entire life? You wouldn't. It would be like paying for a fire extinguisher every month for a house you plan to sell. Instead, you buy coverage for the specific window of time you're most vulnerable. This is the period when your kids are young, your mortgage is huge, and your nest egg is small. This is where term life insurance comes in. It's the star of The Ramsey Show for a reason. It's cheap, it's simple, and it's temporary. You buy a policy for a set term, say 20 or 30 years, with a huge death benefit, maybe 10 to 12 times your income. You pay a relatively small monthly premium, and if you die during that term, your family gets a massive tax-free check. If you don't die, the policy expires and you get nothing back. It's just like car insurance. You pay for it hoping you never have to use it. The money you save by not buying a more expensive, permanent policy is the engine for the whole plan. This is the famous phrase: buy term and invest the difference. He wants you to take that extra $100, $200, $500 a month that you would have spent on a complex whole life policy and plow it into good growth stock mutual funds. Over 20 or 30 years, that invested difference, fueled by compound growth, is what builds your nest egg and gets you to that glorious self-insured finish line. From his perspective, permanent life insurance, like whole life or universal life, is the villain of the story. He sees it as an overpriced, complicated product sold by slick salespeople that tries to do two things at once: provide insurance and act as an investment. And in his view, it does both of them badly. It gives you a lower death benefit for a much higher premium, and the investment part is bogged down by enormous fees, high commissions, and terrible returns compared to just investing in the stock market yourself. It's the financial equivalent of a spork. It tries to be a spoon and a fork, but it's not particularly good at being either. So the Ramsey plan is a neat, tidy package. Buy cheap term insurance for 20 years. Aggressively pay off debt and invest the difference. At the end of the 20 years, your kids are grown, your house is paid off, you have $1 million or $2 million in the bank, and you can let your term policy expire because you, my friend, are self-insured. It's a beautiful, simple, and incredibly appealing blueprint. And for a huge number of people, it works. It is undeniably better than doing nothing. It's a fantastic starting point. But what happens when life doesn't follow the blueprint? What happens when a variable you didn't account for gets thrown into the equation? Because the entire buy term and be self-insured strategy hinges on one massive unspoken assumption: that everything will go according to plan. It assumes your income will consistently grow. It assumes the market will deliver average returns. And most importantly, it assumes that your health will remain stable, or at least that your insurability won't change. Let's imagine a guy named Mark. Mark is 35 years old. He's a Dave Ramsey disciple. He and his wife have 2 young kids, a mortgage, and they're fired up to get their finances in order. They follow the plan to the letter. They buy a 20-year, $1 million term life insurance policy. The premium is incredibly affordable. They take the money they saved and they start baby step 4, investing 15% of their income into mutual funds. The plan is set. By the time Mark is 55, the 20-year term policy will expire, the house will be nearly paid off, and their nest egg should be substantial. They'll be self-insured. Perfect. For 18 years, things go great. They watch their net worth climb. The kids are getting older, now they're in high school thinking about college. The finish line is in sight. Then, at age 53, Mark goes in for a routine physical. A few tests lead to a few more tests and he gets a diagnosis. It's a chronic condition. It's manageable with medication, and his prognosis is good. He's not dying tomorrow. But the diagnosis makes one thing crystal clear. He is now completely 100% uninsurable. No insurance company will ever offer him a new life insurance policy again. Suddenly, the neat, tidy plan doesn't feel so neat and tidy anymore. He looks at his term policy. 2 years left. At age 55, it will vanish. Poof, gone. He looks at his investment portfolio. It's done well, but the last couple of years saw a market downturn, so it's not quite at the number he projected. It's a lot of money for sure. But is it live for the next 30 or 40 years without my income money? Is it pay for 2 college tuitions and 2 weddings money? Is it weather another major market crash money? The certainty is gone. He's now facing a terrifying cliff. At 55, his safety net will be cut away, and he has no way to replace it. The very risk he bought insurance to protect against, leaving his family unprepared, is now looming right in front of him, and it's a risk he might have to face for the next 20 or 30 years of his life. He followed the simple plan. He did everything he was told, but the plan had a blind spot. It accounted for the risk of dying too soon, but it never accounted for the risk of living too long with poor health. This is the fundamental crack in the term is always best foundation. It's a strategy that works perfectly in a perfect world, but it can be incredibly fragile in the real one. It solves for cost and simplicity, but it ignores the brutal reality of human frailty and the unpredictability of life. So what could Mark have done differently? Was he simply doomed by a bad roll of the dice? Or is there another way to structure a financial plan? A way to build a safety net that doesn't have an expiration date? A tool that could have protected him from this exact nightmare? That's where we have to venture into territory that Dave Ramsey considers forbidden, and explore why the products he hates might just be the solution to the problem he doesn't talk about. The product he despises, the one he calls a ripoff, and one of the worst financial products in America, is whole life insurance. And to be fair, his argument against it is incredibly simple, incredibly powerful, and on the surface mathematically sound. For millions of people, it's the only story they've ever heard. Dave's logic goes like this. Whole life insurance is outrageously expensive compared to term insurance. Why? Because you're not just buying a death benefit. You're also bundling it with a savings account feature that has terrible returns and is loaded with hidden fees and fat commissions for the salesperson. He'll tell you the insurance company is just taking your money, investing it for a handsome profit, and then giving you back a tiny, pathetic slice of the pie. His solution, the mantra repeated in 1,000 Financial Peace University classes, is buy term and invest the difference. It's a brilliant piece of marketing and a powerful call to action. The idea is simple. First, you calculate how much insurance you actually need to cover your debts, your mortgage, and your family's income until your kids are grown. Then, you buy a cheap 20 or 30-year level term policy for that amount. It's pure, no-frills protection. It's the fire extinguisher on the wall. Then, and this is the most important part of his entire philosophy, you take the money you save by not buying that expensive whole life policy, that difference, and you religiously invest it every single month into good growth stock mutual funds. According to the plan, by the time your 20 or 30-year term policy expires, you will have built a mountain of cash. Your house will be paid off, your kids will be through college, and your investment portfolio will be so large that you are now, officially, self-insured. You no longer need life insurance because if you die, your spouse has the millions you've accumulated. You've won the game. Your family is protected, and you did it without giving a single extra dime to a greedy insurance company. And you know what? If you are a hyper-disciplined, 100% rational Spock-like human being who never makes an emotional financial decision, who never gets tempted by a new car, who never has an unexpected emergency that drains your savings, and who invests the difference perfectly every single month without fail for 30 straight years, then Dave's plan is mathematically superior. On a spreadsheet, it wins. But there is a Grand Canyon-sized gap between a spreadsheet and real life. And that gap is called human behavior. The fatal flaw in the buy term and invest the difference strategy is that, for the vast majority of human beings, the invest the difference part never actually happens. Life gets in the way. The car transmission goes out. The kids need braces. A dream vacation to Disney World comes up. That difference, that money that was supposed to be diligently invested, gets absorbed into the monthly budget. It becomes restaurant money, shopping money, or just gone money. It's not because people are bad or stupid. It's because we're human. We are wired for immediate gratification, not for 30 years of unwavering robotic discipline. The financial services industry knows this. Studies by Dalbar, a leading financial research firm, consistently show that the average investor earns returns that are drastically lower than the market indexes themselves. Why? Because they buy high out of greed and sell low out of fear. They don't have a system. This is where we have to fundamentally reframe the conversation. Dave Ramsey judges whole life insurance as if it's trying to be a high-growth stock market investment. And when you judge it that way, of course it fails. It's like criticizing a fire extinguisher for being a terrible hammer. It was never designed to be a hammer. Whole life insurance isn't an investment in the same way a mutual fund is. It's a multi-tool. It's primarily an instrument of protection and forced savings. It's a financial foundation, not a rocket ship. Here's how it actually works. When you pay your premium on a properly structured whole life policy, it gets split. One part of the payment goes to cover the pure cost of the death benefit, the insurance itself. This guarantees that no matter when you die, tomorrow or 50 years from now, your family gets a check. The other part of your premium goes into a component called cash value. Think of this cash value as a savings bucket inside your policy. This bucket is contractually guaranteed to grow every single year. It grows tax-deferred. It is completely insulated from stock market crashes, from economic recessions, from whatever financial chaos is happening in the world. It's slow, it's steady, it's boring by Wall Street standards. And it is rock solid. Now let's go back to our man from the beginning, the one who followed Dave's plan. He bought term insurance. He tried to invest the difference. But maybe he wasn't perfect. Maybe he missed a few years of investing when business was slow. Then a health crisis hit. He couldn't work. He stopped investing altogether. He had to drain his 401k to pay medical bills. Then the market crashed, wiping out 40% of what was left. At 62, his term insurance is about to expire. His health is shot, so he can't get a new policy. And his self-insured mountain of cash is now a tiny molehill. He is completely exposed. He followed the popular advice, and it led him to the edge of a cliff. Now imagine an alternate reality. What if 30 years ago, he had put some of his money into one of these terrible whole life policies? Yes, his monthly premium would have been higher. His stock market portfolio might be smaller as a result. But for 30 years, alongside his market investments, he would have been automatically, systematically building up his cash value bucket. It would have been a forced savings plan on autopilot. When his health crisis hit, that cash value would have been there. A liquid pool of capital he could access without penalty, without selling stocks at a loss, without raiding his retirement accounts. It would have been a financial shock absorber, a firewall between his life and his investments. And now, at 62, instead of his insurance disappearing, he would have a permanent death benefit that will be there for his wife no matter what. And he would have this cash value account, a private, accessible source of funds to see him through the storm. One path, the one based on perfect discipline and market luck, led to potential ruin. The other path, the one Ramsey calls a ripoff, provided certainty, stability, and control when everything else fell apart. The argument isn't about which path creates more hypothetical wealth on a spreadsheet in a perfect world. The argument is about which path creates more resilience and options in the real, messy, unpredictable world we all live in. But the story doesn't even end there. Because that cash value, that boring savings bucket, has a hidden superpower. It's a feature that the wealthiest families have used for generations to build and protect their fortunes. A feature that allows you to use your money without ever actually touching it. It turns your policy into your own personal bank, letting you access its value while your cash continues to grow, as if it was never disturbed. This is the part of the story Dave Ramsey never ever tells you, and it changes everything. This mechanism is called a policy loan. And the way it works is the single most misunderstood and intentionally misrepresented feature in all of personal finance. When you hear Dave Ramsey or his disciples mock whole life insurance, they'll say something like, "Why would you ever pay interest to borrow your own money? That's the dumbest thing I've ever heard." And honestly, if that were true, they'd be right. It would be incredibly dumb. But it's not true. It's a fundamental misunderstanding, or a deliberate omission, of how the contract actually works. You are never ever borrowing your own money. Let me say that again. When you take a policy loan, you are not withdrawing your cash value. You are not touching your money at all. Instead, the life insurance company, one of the largest, most stable financial institutions on the planet, is giving you a loan from their own massive capital reserves, their general fund. And what are you using as collateral for that loan? You guessed it. Your cash value. Your cash value sits there, completely secured inside the policy, acting as a guarantee for the loan. And because it's still there, it continues to earn its guaranteed interest. It continues to be eligible for non-guaranteed dividends. It continues to compound, day after day, year after year, completely uninterrupted. Think about it like this. Imagine you own a house free and clear worth $500,000. You need $50,000 for a business opportunity. You could sell the house, get your money, and lose the asset. That's what cashing out a 401k or selling stocks is like. You stop the growth to get the cash. Or you could go to a bank and get a home equity line of credit, a HELOC. The bank gives you a $50,000 loan and puts a lien on your house as collateral. You get the cash and you still own your house. Now here's the magic question. While you're using that $50,000 from the HELOC, does your house stop appreciating in value? No, of course not. The entire $500,000 property continues to grow with the market. You have successfully accessed the equity in your asset without selling the asset itself. A policy loan works on the same principle, but it's even better. It's like a HELOC on steroids. With the house, appreciation isn't guaranteed. The market could go down. With a properly structured whole life policy from a mutual company, your cash value growth is contractually guaranteed to go up every single year. It will never ever be worth less than it was the year before. Furthermore, there's no loan application, no credit check, no talking to a loan officer and explaining what you need the money for. It's your money, your collateral, your contract. You call the company, request a loan, and they send you a check or wire the money, typically within a few days. The repayment terms? They're completely up to you. You can pay it back on a monthly schedule, pay just the interest, or pay nothing at all and just let the loan balance be deducted from the death benefit when you pass away. You are in complete and total control. You have become your own banker. This is the power of uninterrupted compound interest. Albert Einstein supposedly called compounding the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. When you pull money out of your 401k or sell stocks, you are interrupting the compounding process. You're not just losing the money you took out, you're losing all the future growth that money would have generated for the rest of your life. With a policy loan, the compounding never stops. Let's put some simple numbers to this. Say you have $100,000 in cash value, and it's earning a hypothetical 5% that year between the guaranteed rate and the dividend. That's $5,000 in growth. Now let's say you need to borrow $20,000. You take a policy loan. The insurance company sends you $20,000 from their general fund. Your $100,000 of cash value remains in your policy. At the end of the year, how much does your cash value grow by? It grows by 5% of the full $100,000. It still earns $5,000 even though you have $20,000 of that value in your pocket, being used elsewhere. Meanwhile, the insurance company is charging you interest on the loan. Let's say the loan interest rate is also 5%. So you owe $1,000 in interest on your $20,000 loan. But wait, your policy's cash value grew by $5,000. The net effect is that you got to use $20,000 tax-free for a full year, and you still came out $4,000 ahead inside your policy. The loan essentially cost you nothing. This is what's known as a wash loan, and in some cases you can even have positive arbitrage, where the growth on your cash value is higher than the interest rate on your loan, meaning the insurance company is literally paying you to borrow money. This flies directly in the face of the Ramseyism that you're borrowing your own money and paying interest. It's a fiction. You're borrowing the insurance company's money, while your money continues to work for you. This is how the wealthy use life insurance. It's not just a death benefit. It's a private, tax-advantaged, liquid pool of capital they can access at any time, for any reason, without interrupting its growth. It's the ultimate financial emergency fund. It's a source of capital for investments. It's a way to finance major purchases like cars or even a down payment on a house, all while your wealth continues to compound in the background. Now, there are two main ways companies handle this, and it's important to know the difference. It's called direct versus non-direct recognition. With a non-direct recognition company, they truly don't care if you have a loan or not. They pay you the exact same dividend rate on your entire cash value, whether you have a zero loan balance or have borrowed the maximum amount. Your loan activity is completely separate from your policy's performance. With a direct recognition company, they do recognize that you have a loan, and what they do is they pay a different dividend rate on the portion of your cash value that is securing a loan. Now, at first glance, that sounds worse. But often, these companies will credit the portion of your cash value with the loan against it with a rate that is very close to, or equal to, the loan interest rate they are charging you. So even with direct recognition, you often end up with a wash loan, where the net cost of borrowing is zero or very close to it. It's just a different accounting method to get to a similar result. The point is, the system is designed to allow you to use your money without stopping its momentum. Compare this to Dave's advice. He tells you to have an emergency fund of 3 to 6 months of expenses sitting in a money market account. What is that money earning you? Today maybe you get a decent rate. But for the last decade it was earning next to nothing. It was losing purchasing power to inflation every single day. It was dead money. With a whole life policy, your emergency fund is supercharged. It's liquid, it's accessible, but it's also growing, compounding, and protected from market volatility. It's an emergency fund that actively builds your wealth instead of just sitting there. This concept of becoming your own banker, of having a financial vehicle that provides a death benefit, guaranteed growth, tax advantages, and a private, uninterrupted source of financing. This is the core of what makes permanent life insurance such a powerful tool. It's not an investment in the same way a stock is. It's the financial foundation upon which all your other investments can be built and protected. It is the moat around your financial castle. And it's the one thing that the buy term and invest the difference crowd completely and conveniently ignores. But now you know. So the question becomes, is this secret engine powerful enough to compete with Dave's preferred strategy of just plowing everything into the stock market? Can this slow, steady, guaranteed compounding machine actually keep up with the raw power of an S&P 500 index fund over the long run? The math on that is fascinating, and it's exactly what we're going to break down next. Let's run the numbers. To do this, we need a real-world example. So let's invent a guy. We'll call him John. John is 35 years old. He's married with 2 young kids. He's in good health, and he's a non-smoker. He's the ideal candidate. He and his wife have done the math, and they've decided they need a $1 million life insurance policy to make sure the family is taken care of if he's no longer around. So John goes shopping, and he's presented with 2 very different paths to that same $1 million death benefit. Path number 1 is the Dave Ramsey way. Buy term and invest the difference. John gets a quote for a 30-year, $1 million term life policy. Because he's young and healthy, the premium is surprisingly affordable. Let's say it comes in at $80 a month. For $80, his family is protected with $1 million until he's 65 years old. The plan is that by then, the kids will be grown, the house will be paid off, and he'll have a massive nest egg built up. He'll be, in Dave's words, self-insured. Path number 2 is the whole life insurance path. The agent shows him a policy from a reputable, old-school mutual insurance company. It also has a $1 million death benefit, but this benefit never expires. It's permanent. And it has that cash value savings account built right inside of it. But this all-in-one package comes at a much higher price. For the same $1 million coverage, John's premium for the whole life policy is quoted at $800 a month, 10 times more expensive. The whole life agent explains that this isn't a fair comparison. He says, "John, you can't compare them on price because they're 2 completely different products. One is like renting a house, the other is like buying one. With term, you're just renting protection. With whole life, you're building equity. This is the fork in the road. This is the exact point where the entire debate begins. So let's follow both paths to their conclusion, 30 years down the line, when John is 65 years old. Let's start with path 1, buy term and invest the difference. John pays his $80 a month for the term policy. The difference in premium between the whole life policy and the term policy is $800 minus $80, which is $720 a month. Every single month, like clockwork, John takes that $720 and invests it into a simple, low-cost S&P 500 index fund. He never touches it. He just lets it ride the waves of the market for 3 decades. Now, what kind of return can he expect? Dave Ramsey famously uses a 12% average annual return in his examples, which is historically possible but definitely on the optimistic side. Financial advisors often use 8 to 10% for their projections. So let's be a little more conservative than Dave and use a 10% average annual rate of return. So what does $720 a month invested for 30 years at a 10% average return turn into? The answer is staggering. At age 65, John's investment account would be worth over $1.6 million. Let me say that again. $1.6 million. His total contribution over those 30 years was about $260,000. The other $1.3 million? That's pure, unadulterated compound growth. At this point, his 30-year term insurance policy expires. It's gone, but it doesn't matter. With $1.6 million in the bank, he is officially self-insured. If he passes away, his wife has the nest egg. Mission accomplished. This is the entire foundation of the Dave Ramsey argument, And when you see a number like that, it's incredibly compelling. But now we have to look at path 2. What happened to the John who chose the whole life policy? He's been diligently paying his $800 a month for the same 30 years. What does he have to show for it at age 65? First, he still has his $1 million death benefit. Unlike the term policy, it hasn't expired. It's there for life, and it will be paid out to his family tax-free whenever he passes away. That's a significant checkmark in the pro column. Second, he has his cash value. How much is in there? Well, over 30 years, he paid in a total of $288,000 in premiums. The cash value inside the policy is guaranteed to grow, and it will also receive non-guaranteed dividends from the insurance company's profits. After 30 years of slow and steady growth, a well-performing policy might have a cash value of around, let's say, $550,000. Now let's put them side by side. The championship round. Age 65. In this corner we have John from Path 1, Team Ramsey. His term insurance is gone, so he has a $0 death benefit. But he's sitting on a liquid investment portfolio worth $1.6 million. And in this corner we have John from Path 2, Team Whole Life. He has a permanent $1 million death benefit that's guaranteed to pay out. And he has access to $550,000 of cash value inside his policy. When you look at it like that, it seems like an open and shut case. $1.6 million versus $550,000. It's not even close. Team Ramsey wins by a knockout. You'd have to be crazy to choose the whole life policy, right? You're giving up over $1 million in wealth just to have a permanent death benefit. This is the exact math Dave Ramsey and his followers point to, and honestly it's hard to argue with. The raw power of the stock market, even at a conservative 10% return, seems to absolutely crush the slow, plodding growth of a whole life policy. But this is where the story gets a crucial twist. The whole life advocates look at this exact scenario and say, you're missing the most important details. You're comparing apples and oranges, and you're ignoring the hidden risks of Dave's plan and the hidden benefits of ours. They argue that our simple comparison leaves out 3 critical factors that can completely change the outcome. Those factors are taxes, risk, and control. They would say that $1.6 million in the stock market is not the same as $550,000 in a life insurance policy. For one, that $1.6 million is not all yours. A big chunk of it belongs to Uncle Sam in the form of capital gains taxes. The $550,000 in cash value? There are ways to access that completely tax-free. They would also point out that the 10% market return is just an average. It is absolutely not a guarantee. What happens if the market crashes right when you need the money? Your $1.6 million could become $1 million overnight. The growth in the whole life policy, however, is guaranteed. The cash value can never ever go down. And finally, they talk about discipline. They argue that the idea of a person religiously investing that difference every single month for 30 years without ever rating the account for a new car or a vacation is pure fantasy for most people. The whole life policy, they claim, is a forced savings mechanism that builds wealth automatically. So on paper, Dave Ramsey wins in a landslide. Case closed, right? Well, not so fast. Because the whole life advocates have a trump card they're about to play. It's a card that involves leveraging those tax rules, eliminating market risk, and using a strategy that they claim turns your life insurance policy into your own personal tax-free bank. And that's where this debate gets really interesting. This strategy is most famously known as the infinite banking concept, or IBC. Sometimes it's called becoming your own banker, or a 7702 plan, after the section of the tax code that governs it. And at its core, it's about a fundamental shift in thinking. The proponents of this strategy argue that you finance everything you buy. You either pay interest to someone else like a bank for a car loan or a mortgage, or you give up the interest you could have earned by paying with cash. Think about that for a second. When you pay $40,000 cash for a car, you're not just losing the $40,000. You're losing what that $40,000 could have grown into for the rest of your life. That's an opportunity cost. The infinite banking concept is designed to solve that problem. It's about creating a system where you can recapture the interest you would normally pay to a financial institution and keep your capital compounding even while you use it. So how does it work? The vehicle for this strategy is not just any old life insurance policy. It's a very specific type. A dividend-paying whole life insurance policy, issued by a mutual insurance company. This is a critical detail. A mutual company is owned by its policyholders. So when the company is profitable, it pays out those profits to its owners, the policyholders, in the form of a dividend. Now, this isn't like a stock dividend. The IRS views it as a return of an overpayment of premium, which means these dividends are not considered taxable income. This is a huge advantage right out of the gate. But here's the real secret sauce, the part that separates this from the clunky whole life policies Dave Ramsey rightfully criticizes. These policies are engineered from the ground up to maximize cash value growth, not the death benefit. The way they do this is through something called a paid-up additions rider, or PUA. Think of the PUA rider as a turbocharger for your cash value. When you pay your premium, a small portion goes to the base policy, which buys you a certain amount of death benefit. But the majority of your premium, often as much as 80 or 90%, is directed into this PUA rider. This money buys you small, fully paid-up chunks of additional life insurance. But more importantly, it almost entirely bypasses the heavy upfront commissions and fees associated with traditional whole life, and it goes directly to work building your cash value from day one. You are intentionally overfunding the policy, cramming as much cash into it as the IRS will legally allow without it becoming a taxable investment. This cash value then grows in three ways. First, you have a contractually guaranteed rate of return. This is the bedrock of the policy. The insurance company guarantees your cash value will grow by a certain percentage, typically around 3 to 4%, every single year, no matter what the stock market does. This is your floor. Can never go down. Second, you have those non-guaranteed dividends we talked about. Historically, the top mutual companies have paid dividends consistently for over 150 years, through the Great Depression, World Wars, the 2008 financial crisis, everything. And here's where the compounding really kicks into high gear. You use those dividends to purchase even more paid-up additions, which then generate their own guaranteed growth and their own future dividends. It's a snowball of wealth rolling downhill. Okay, so the money is growing in a safe, tax-advantaged way. But how do you use it? How does it become your own personal bank? The answer is the single most misunderstood and powerful feature of these policies, the policy loan. When you want to access your money, you do not withdraw it. Withdrawing the cash would be a taxable event and you'd lose the compounding power. Instead, you take a loan from the insurance company using your cash value as collateral. This is a profound distinction. Let's say you have $100,000 in your cash value, and you need $30,000 to buy a car. You call the insurance company and they send you a check or wire you the money for $30,000. There's no loan application, no credit check, no underwriting. You don't have to tell them what it's for. It's your money, you have a contractual right to it. But here is the magic. Because you didn't actually withdraw your $100,000, you just used it as collateral, your entire $100,000 cash value remains in the policy, earning that guaranteed interest in those non-guaranteed dividends. You have the insurance company's money in your checking account, and your money is still working for you as if you never touched it. This is called uninterrupted compound interest. You are literally using your money in two places at once. Now, you do have to pay interest on that loan back to the insurance company. And this is where the critics, including Dave, will jump up and say, "See, it's a scam. You're paying interest to borrow your own money." But proponents of infinite banking will tell you that's the wrong way to look at it. First, remember your entire cash value is still compounding. In a well-designed policy, the growth rate of your cash value is often higher than the interest rate on the loan. So you might be paying 5% interest on the loan, but your cash value is growing by 6%, creating what's called a positive arbitrage. You're literally making a profit on the money you've borrowed. Second, you determine the repayment schedule. You can pay it back slowly, quickly, or you can let the interest accrue and have it deducted from the death benefit when you pass away. You are in complete control. You've become the banker. You've taken the role that big banks play in our lives and you've brought it in-house. Imagine you're a real estate investor. You find a great deal on a property that needs a $50,000 down payment. Instead of going to a hard money lender and paying 12% interest and high fees, you take a policy loan. Your money keeps compounding, you get the property, and you pay the loan back on your terms. You've financed a major purchase while your wealth continued to grow uninterrupted in the background. You've eliminated the bank from the equation. This is the core promise of infinite banking. It's not about getting rich quick. It's not about beating the stock market. It's about creating a safe and predictable pool of capital that you control, that gives you liquidity and options, and that grows tax-free, all while providing a death benefit to protect your family. It's positioned not as an either/, or to Dave Ramsey's investment advice, but as a foundational and. It's the financial fortress where you store your cash before you deploy it into other investments. So if this strategy is so powerful, If it allows you to earn uninterrupted compound interest, access your money tax-free, and create a legacy for your family, why isn't everyone doing it? Why does a financial guru with millions of followers like Dave Ramsey call it one of the worst financial products in America? Well, the answer is that this beautiful, powerful theory can collide with a very messy and expensive reality. The structure of the policy, the commissions paid to the agent, and the discipline required from the policyholder are all points of failure. And it's in those details that this strategy can either become the cornerstone of your wealth or a financial trap that drains your cash for decades. So let's talk about that financial trap. Because the critics, Dave Ramsey included, have some incredibly valid points that you absolutely must understand before even thinking about this. The number one reason whole life gets a bad name is the commissions. They are brutally high in the early years. Imagine buying a $10,000 mutual fund, but on day one, your statement says it's only worth $2,000 because the advisor took an $8,000 fee up front. You'd be furious, right? Well, that's not far from how a whole life policy feels for the first several years. A huge portion of your initial premiums, sometimes over 50%, goes directly to the agent and the insurance company's overhead. This is why, for the first 5, 10, sometimes even 12 years, the cash surrender value of your policy, the money you'd get back if you quit, is less than the total amount you've paid in premiums. This is the valley of death for these policies. It's where most people give up. They look at their statement in year 6, see they've paid in $30,000 but only have $22,000 in cash value, and they feel scammed. They cancel the policy, take the loss, and then go tell everyone they know that whole life insurance is the biggest ripoff ever invented. And from their perspective, they're not wrong. They paid for a benefit, got frustrated with the slow start, and walked away with less money than they started with. The insurance company designed it this way. They know a certain percentage of people will quit early. Those surrendered policies, with their associated fees and losses, are pure profit for the company. They are banking on your lack of discipline. This brings us to the core of Dave Ramsey's argument. Buy term and invest the difference. It's mathematically elegant and, on a spreadsheet, it's almost impossible to beat. Let's run the numbers. Say a 35-year-old man wants $1 million death benefit. A 30-year term policy might cost him $75 a month. A whole life policy with the same death benefit might cost him $750 a month. That's a difference of $675 every single month. The Ramsey strategy says, you take that extra $675 and you religiously invest it into good growth stock mutual funds like an S&P 500 index fund. If we assume a conservative 9% average annual return over the next 30 years, do you know what that $675 a month turns into? It's not a small number. It becomes over $1.3 million. That's right. By the time the 30-year term policy expires at age 65, you have zero life insurance, but you have a $1.3 million nest egg. You have become, in Ramsey's words, self-insured. You don't need the death benefit anymore because you have the cash. Game over. You won. On paper, this is a slam dunk. It seems foolish to do anything else. But we don't live our lives on a spreadsheet. We live in the messy, unpredictable real world, where human behavior is the most important variable. And the invest the difference strategy has a massive, glaring weakness. It requires 30 years of unwavering robotic discipline. It assumes you will actually invest that $675 every single month, without fail for 360 consecutive months. It assumes that when your car breaks down, you won't pause the contribution. It assumes that when you get a raise, you won't just absorb that money into your lifestyle with a nicer car or a bigger house. It assumes that during a market crash like in 2008 when everything is down 50%, you won't panic sell or stop investing out of fear. The reality is, most people don't have that kind of discipline. The financial services industry has studied this for decades. It's called the behavior gap, the difference between the return of an investment and the return of the average investor. The S&P 500 might average 10%, but the average investor in an S&P 500 fund earns closer to 7% because they buy high and sell low. They get excited when the market is up and terrified when it's down. Whole life insurance, for all its flaws, solves the behavior problem. The premium is a bill. It's not an optional investment. It's a mandatory payment you make just like your mortgage. It forces you to save. It automates wealth creation by making it feel like an expense. For a huge portion of the population, this forced savings is the only way they'll accumulate any significant cash outside of their 401k. But the real magic, the part of the story that the buy term and invest spreadsheet completely ignores, is what happens inside that cash value account. It's not just a savings account. It's a financial vehicle with a unique set of rules that you cannot replicate anywhere else. And it all comes down to taxes. Your cash value grows tax-deferred. This means you don't pay taxes on the growth each year. This is similar to a 401k or an IRA, but that's where the similarities end and the advantages begin. When you want to access the money in your 401k, you have to take a withdrawal, which is taxed as ordinary income. If you pull out $50,000, you might only get to keep $35,000 after taxes. But with a whole life policy, you don't withdraw your money. You take a loan against your cash value from the insurance company. Because it's structured as a loan, it is 100% income tax-free. Let me repeat that. You get tax-free access to your capital for the rest of your life. This is a monumental advantage. But it gets even better. This is the part that sounds like it can't possibly be true. When you take that loan, your cash value, the full amount, is still sitting in your policy being used as collateral. And that full amount continues to earn uninterrupted compound interest and dividends, as if you never touched it. Think about that. If you have $100,000 in cash value and you take a $50,000 loan, you receive $50,000 tax-free to use for whatever you want. Meanwhile, the full $100,000 in your policy is still compounding for you. You are literally using your money in two places at once. You cannot do this with a 401k. You cannot do this with a brokerage account. If you sell $50,000 worth of stock to get cash, that $50,000 is gone. It is no longer in the market, no longer working for you, and you've likely created a taxable event. With a properly structured whole life policy, your capital never stops compounding. You can use it to pay for a child's college education, to start a business, to buy a piece of real estate, all while the underlying asset continues to grow. You become your own source of financing. You are literally banking on yourself. Imagine you want to buy an investment property that requires a $60,000 down payment. The Invest the Difference person has to sell $60,000 of their mutual funds. They trigger a capital gains tax, and that money is now gone from their portfolio forever, its potential future growth evaporated. The whole life policyholder simply takes a $60,000 tax-free loan from their policy. Their cash value continues to grow. And now they also own a cash-flowing rental property. They can even structure the rent payments from the property to pay back the policy loan. It's a powerful and sophisticated strategy that transforms a simple insurance product into a private family bank. A financial fortress that provides liquidity, safety, and tax advantages you just can't get from the stock market alone. This isn't about getting a 12% return. It's about control, flexibility, and efficiency. It's about what your money can do for you while you're still alive. And that's a conversation that gets lost when you only focus on the death benefit. Let's unpack that, because this is where the entire conversation shifts from a simple, by term, and invest the difference spreadsheet calculation to a multidimensional strategy for wealth. When we talk about what your money can do for you while you're alive, we're talking about transforming a death benefit into a living, breathing financial tool. We're talking about creating your own private family bank. Now that phrase, private family bank, sounds like some secret society handshake, something reserved for the Rockefellers or the Vanderbilts. But the concept is surprisingly simple, and it's built on that cash value we've been discussing. Imagine for a moment that you no longer had to go to a bank hat in hand to ask for a loan for life's major purchases or opportunities. Instead, you go to your own policy. Let's make this real. You need to buy a car. The Dave Ramsey way says to save up and pay cash. A noble goal, and absolutely the best way to avoid paying interest to a bank. But it can take years. The typical American way is to go to a dealership, get a loan at 7, 8, maybe even 10% interest, and then spend the next 5 years sending a chunk of your income to a faceless lending institution. Every single one of those interest payments is money you will never see again. It's a wealth transfer from you to the bank. Now consider a third path. You have a properly structured whole life policy with, say, $50,000 in cash value. You find the car you want for $30,000. Instead of withdrawing your money, you take a loan against your cash value from the insurance company. The insurance company sends you a check for $30,000. You go and pay cash for the car just like Dave would want. But here's the magic. First, the process was private. No credit checks, no loan applications, no nosy loan officer asking for your pay stubs. You are the one in control. Second, you set the repayment schedule. You can pay it back aggressively in 2 years or take 10 years. It's your call. The interest you pay on that loan goes back to the insurance company, which is a mutual company owned by you, the policyholder. But here is the part that breaks most people's brains. While you have that $30,000 loan, your original $50,000 of cash value is still in your policy, acting as collateral. And because it's still there, it continues to earn uninterrupted compound interest and dividends, as if you never touched it. Let that sink in. The bank charges you 8% on a car loan, and that money is gone forever. With your policy, you might pay 5% on the loan, but your underlying cash value is still growing at, say, 4%. Your net cost is a fraction of what the bank would charge, and you're essentially paying yourself back. You are recapturing the financing function in your own life. You turned a major expense into an opportunity to keep your capital working for you. Your money is doing two jobs at once. It bought you a car, and it continued to grow inside your policy. This is a level of financial efficiency that, by term and invest the difference, simply cannot replicate. Let's take it a step further. An incredible business opportunity lands on your desk. A partner needs a $50,000 investment, and they need it in a week. You know it's a home run. What are your options? Go to a bank? They'll take weeks, maybe months, to approve a business loan if they approve it at all. Sell your stocks? Well, what if the market is down 30%? You'd be forced to sell low, locking in massive losses, destroying years of potential growth. This is the exact scenario where people with money make more money, and people without access to liquid capital are left on the sidelines. But with your policy, you call the insurance company. The money is wired to your account in a matter of days. No questions asked. You make the investment. You seize the opportunity. This is what we mean by control and flexibility. Your cash value becomes your opportunity fund. It becomes your emergency fund on steroids. Think about Dave Ramsey's emergency fund. He advises 3 to 6 months of expenses sitting in a savings account or money market fund. And he's right, you absolutely need that liquidity. But what is that money doing for you? In today's environment, it's earning next to nothing. It's losing purchasing power to inflation every single day. It's dead money sitting on the sidelines waiting for a disaster. The cash value in a whole life policy serves the same purpose. It's there when you need it for an emergency, but it's not dead money. It's constantly working. It's growing tax-deferred. It's protected from creditors in most states. And it's linked to a permanent death benefit that will never expire. You're solving for the same problem, the need for liquidity, but in a far more efficient and productive way. Now, the big objection, the point of confusion that critics always raise is this: why should I have to pay interest to borrow my own money? It's a fair question, but it's based on a misunderstanding of the transaction. You are not borrowing your own money. You are taking a loan from the insurance company's general fund and simply using your cash value as collateral, just like you use your house as collateral for a mortgage. This distinction is everything, because your money technically never leaves your policy, it never stops compounding. Imagine you have $100,000 in a savings account earning 1%. You withdraw $50,000. You now have $50,000 left, and you're only earning interest on that remaining $50,000. You interrupted the compounding on half your money. With a policy loan, your full $100,000 of cash value remains inside the policy, receiving dividends and interest on the full amount. The insurance company gives you $50,000 from their massive reserves and charges you interest. Because they are still paying you dividends on your full cash value, the net cost of that loan is incredibly low. You get the liquidity you need without ever interrupting the powerful engine of compound growth. It's a financial superpower. This is the fundamental difference people miss. Term insurance is an or asset. Either you die and your family gets the money, or you live and the policy expires worthless. You get nothing. A properly designed whole life policy is an and asset. You have tax-free access to your cash value while you're alive for opportunities and emergencies, and your family receives a tax-free death benefit when you pass away. It is a tool for the living and a legacy for the future. It transforms life insurance from a morbid expense you hope you never use into a dynamic private source of capital that you can use to build wealth throughout your entire life. It's about playing both offense and defense with your money at the same time. But if this is also powerful, if it creates your own private bank and provides this incredible financial efficiency, why is it so controversial? Why does Dave Ramsey call it a ripoff? Why do so many financial gurus scream from the rooftops that you should never, ever buy it? Is there a dark side to this strategy that we're conveniently ignoring? The answer is yes, there is. And it's critically important to understand the commissions, the costs, and the ways these policies can be misused before you ever consider one. Let's start with the single biggest reason permanent life insurance gets such a bad reputation. the commissions. They aren't just big. They are astronomical. On many whole life or indexed universal life policies, the insurance agent can receive a commission of anywhere from 50 to over 100% of your entire first year's premium. Let me say that again. You decide to put $10,000 into a policy for the first year. In many cases, the agent who sold it to you could walk away with a check for $10,000 or even more. Your entire first year's contribution could go straight into their pocket. Now, why is this a problem? It creates a monumental conflict of interest. The agent has an enormous, life-changing financial incentive to sell you this specific product, whether it's the best solution for you or not. Their motivation isn't necessarily your long-term financial well-being. It's the massive, front-loaded payday. This is the original sin of the life insurance industry, the one that taints every conversation. It's why people like Dave Ramsey are so skeptical, and frankly, it's why you should be too. A fee-only financial advisor, by contrast, might charge you 1% of your assets per year. Their incentive is to make your assets grow over the long term because that's how they make more money. The insurance agent's incentive is to get your signature on the dotted line today. But the commissions are just the cover charge to get into this very expensive club. Once you're inside, the fees begin. This is the labyrinth of costs that is almost intentionally designed to be confusing. First, you have the actual cost of insurance. This is the part of your premium that pays for the death benefit, the term part of your permanent policy. But here's the dirty secret. This internal cost isn't level. As you get older, the actuarial risk of you passing away increases, and so does this internal cost of insurance. So while your premium payment might be the same every month, a growing portion of that payment is being eaten up by the rising cost of the death benefit, leaving less and less to go into your cash value. Then there are the administrative fees, policy fees, and premium load charges. These are percentages and flat fees skimmed right off the top of every dollar you contribute, or siphoned from your account every month, just to keep the lights on. They're like barnacles on a ship, creating a constant, relentless drag on your cash value's growth. But the most punitive cost of all is the surrender charge. This is the industry's golden handcuffs. If you want to access your own cash value or cancel your policy within the first 10 to 15 years, the insurance company will hit you with a massive penalty, the surrender charge. In the first few years, this charge can be so high that it wipes out your entire cash value. You could pay in $20,000 over 2 years, decide it's not for you, and walk away with zero. This is why the cash value on these policies looks so pathetic in the early years. It's not just the commissions. It's the surrender charges holding your money hostage. It's a system designed to punish you for changing your mind, locking you into a product for over a decade before you can access your money without a penalty. Now let's talk about the modern, sophisticated cousin of whole life, Indexed Universal Life, or IUL. This is the product you see all over TikTok and Instagram, pitched as the ultimate financial secret of the wealthy. The sales pitch is intoxicating. You get the upside of the stock market like the S&P 500 with none of the downside risk. When the market goes up, you get credited interest. When the market goes down, you lose nothing. Zero is your hero. It sounds like the perfect investment. Sounds too good to be true. And it is. The promise of market-like returns without the risk is an illusion, crafted by a series of limitations they don't put on the glossy brochure. First, there's the cap rate. The insurance company will say you can participate in the market's gains, but only up to a certain point. For example, the cap might be 9%. If the S&P 500 has a phenomenal year and goes up 25%, you don't get 25%. You get 9%. You get a small slice of the good years, completely missing out on the explosive wealth-building rebound years that are essential for long-term growth. Then there's the participation rate. This means you only get to participate in a certain percentage of the index's return, even below the cap. A policy might have an 80% participation rate. So if the market goes up 10% and your cap is 10%, you don't get 10. You get 80% of that 10%, which is 8%. And sometimes, instead of those, they use a spread. This is where the insurance company simply schemes a percentage off the top before you get anything. If the spread is 2% and the market goes up 10, they take their 2% first and you get 8. Do you see what's happening? Cap, participation, spread, they are all just different levers the insurance company can pull to severely limit your upside potential. They keep the lion's share of the returns for themselves. And that zero is your hero line? It's misleading. While it's true you might get a 0% interest credit in a down market year, you are still paying all those fees we talked about. The cost of insurance, the administrative fees, they all still come out of your cash value every single month. So while you're not losing money to the market, your account value is absolutely going down because it's being eaten away by the policy's own internal costs. This brings us to the most insidious part of this whole structure, the illustrations. When an agent pitches you one of these policies, they'll show you a chart, a projection of how your money could grow over the next 30 or 40 years. It will show beautiful, smooth, upward-sloping lines, projecting you'll have millions of dollars tax-free for retirement. But you have to read the fine print. These illustrations are hypothetical. They are not guarantees. They are sales tools based on current cap rates, current costs of insurance, and current dividend rates that the insurance company can change at any time. The company has the right to lower the cap rates in the future. They have the right to raise the internal cost of insurance, up to a guaranteed maximum that is often astronomically high. If they do that, that beautiful illustration falls apart. Your policy could stall, or even worse, it could implode. The cash value could be completely eaten up by rising internal costs in your later years, causing the entire policy to lapse and leaving you with nothing but a huge tax bill for any gains you took out along the way. It is a system built on complexity and confusion. When you don't understand the moving parts, the front-loaded commissions creating a conflict of interest, the surrender charges trapping your money, the rising internal costs, and the non-guaranteed levers that limit your growth, you are at the mercy of the salesperson. You are basing a multi-decade financial decision on a hypothetical illustration from someone who stands to make a 5-figure commission the moment you sign. So, after all of that, it sounds like Dave Ramsey is 100% right and these policies are a scam, right? Case closed? Buy term and invest the difference, end of story? Well, not exactly. Because what the buy term and invest the difference crowd never talks about are the unique, almost unbelievable tax advantages and legal protections that are baked into the DNA of these policies by the IRS tax code itself. And for a very specific type of person in a very specific situation, these advantages can be so powerful that they can, in fact, outweigh all of the massive negatives we just discussed. Who is that person? And how do they structure a policy to actually make it work? That's what we'll uncover in our final part. To understand who this person is, we have to stop thinking about life insurance as an investment. We have to stop comparing it to the S&P 500. For this specific individual, permanent life insurance isn't an investment vehicle. It's a tax and estate planning tool. It's a legal and financial instrument used to solve problems that a 401k or a brokerage account simply cannot solve. So, who is this person? This is the high net worth individual. We're not talking about someone who's just a millionaire. We're talking about someone who has maxed out every single tax advantage savings vehicle available to them. Their 401k is maxed. Their Roth IRA is maxed. Their health savings account is maxed. They have a robust taxable brokerage account. They have a net worth well into the 7 or more likely 8 figures. For this person, their financial problems are no longer about accumulation. They're about preservation, protection, and transfer of wealth. And for them, a properly structured permanent life insurance policy offers 3 almost unbeatable advantages. First, and most importantly, is the tax-free death benefit for estate planning. As of 2024, the federal estate tax exemption is over $13 million per person. That sounds like a lot, and it is. But for a successful business owner or a real estate investor, their estate can easily surpass that, especially for a married couple with a combined exemption of nearly $27 million. And that exemption amount is scheduled to be cut in half in 2026. On top of that, many states have their own much lower estate or inheritance tax thresholds. Imagine a family owns a business worth $30 million. When the parents pass away, their estate could face a tax bill of millions of dollars, due in cash within 9 months. But the family's wealth isn't in cash. It's tied up in the business, the building, the equipment, the inventory. To pay the tax man, the children might be forced to sell the family business, the very legacy their parents spent a lifetime building. This is where permanent life insurance becomes a silver bullet. A multi-million-dollar life insurance policy can be set up inside a special legal structure called an irrevocable life insurance trust, or ILIT. This means the trust owns the policy, not the individual. When the person dies, the death benefit, say $10 million, is paid directly to the trust, completely free of income tax and estate tax. The trust then provides the immediate, tax-free cash the family needs to pay the estate taxes, preserving the family business for the next generation. Term insurance can't solve this problem, because the need is permanent. You don't know if you're going to die in the next 20 years, but you know you're going to die eventually. This is a permanent problem that requires a permanent solution. The second advantage is tax-advantaged cash accumulation. Now, this is where everyone gets tripped up, and where Dave Ramsey rightly points out the terrible returns. But for the wealthy individual who has already maxed out every other tax-advantaged account, this becomes what some advisors call a private pension, or a Roth on steroids. They don't use it to get rich. They use it to stay rich with less tax drag. Here's how it's structured, and this is the critical difference. A typical whole life policy sold to the middle class is designed with the highest possible death benefit for the lowest possible premium. This maximizes the agent's commission and minimizes cash value growth. A policy for a high net worth individual is structured in the exact opposite way, with the lowest possible death benefit allowed by the IRS for the highest possible premium. The goal is to overfund the policy, stuffing as much cash into it as legally possible without it becoming what's called a modified endowment contract, or MEC, which would make it lose its favorable tax treatment. By doing this, a much smaller percentage of the premium goes to the cost of insurance, and the vast majority goes straight into the cash value where it grows tax-deferred. Then, in retirement, the policy owner can take out tax-free loans against this cash value. They're not technically withdrawals, they're loans. They don't have to pay them back, because when they die, the outstanding loan balance is simply subtracted from the death benefit before it's paid out. For someone in a high tax bracket, having access to a pool of tax-free capital in retirement is an incredibly powerful diversification tool against future tax rate hikes. The third advantage is asset protection. For doctors, lawyers, business owners, and other high-income professionals, the risk of being sued is very real. In many states, the cash value held inside a life insurance policy is legally protected from creditors and lawsuits. This means that if you're sued and a judgment is entered against you, creditors can go after your bank accounts, your brokerage accounts, and your real estate, but they often can't touch the cash value in your life insurance. It acts as a financial fortress, shielding a portion of your wealth from legal predators. This is a level of protection that a simple brokerage account just doesn't offer. So, when you combine these three benefits, a permanent tax-free death benefit for estate liquidity, a tax-advantaged vehicle for overaccumulation, and creditor protection, you can see why this tool is so attractive to a very specific, very wealthy demographic. This brings us back to the central question. Is Dave Ramsey wrong? The answer is a definitive no. Dave Ramsey is not wrong. He is, in fact, profoundly right for 99% of the population. His audience is not the person with a $30 million estate tax problem. His audience is the person with $30,000 in credit card debt. His audience is the family trying to save for a down payment, get their kids through college, and build their first $1 million. For that person, for the vast majority of Americans, permanent life insurance is a financial disaster. It's a high-cost, low-return product that sucks away precious dollars that should be going towards paying off debt and investing in low-cost index funds. The message by Term and Invest the Difference is simple, it's effective, and it has created more millionaires than any complex insurance strategy ever will. Dave's genius is in behavioral finance. He understands that complexity is the enemy of action. The strategies we've just discussed are incredibly complex. They require a team of specialists, a tax attorney, a certified public accountant, and a highly qualified insurance advisor who understands these intricate policy designs. They are also ripe for abuse. Unscrupulous agents often pitch these complex products to people who don't need them, highlighting the potential gains while burying the exorbitant fees and surrender charges. Dave's blanket condemnation is a protective measure. It's a bright red line that keeps his followers from wandering into a financial minefield. So, the verdict isn't about who is right and who is wrong. It's about understanding the context. It's about using the right tool for the right job. You wouldn't use a sledgehammer to perform surgery, and you wouldn't use a scalpel to demolish a building. For the person digging out of debt, building an emergency fund, and starting their investment journey, term life insurance is the scalpel. A precise, low-cost tool that does one job perfectly: protect your family's income. Permanent life insurance for this person is a sledgehammer that will demolish their budget and their financial future. But for the person who has already built the skyscraper, the person whose concerns have shifted from building wealth to preserving it across generations, that same sledgehammer, when wielded by a team of experts, becomes the necessary tool to solve massive tax and estate problems. The ultimate lesson here is not to blindly follow any single guru, not even Dave Ramsey. The goal is to understand the fundamental principles behind their advice. Understand why Dave recommends term life. It's because it's cheap, simple, and allows you to put your money to work more effectively elsewhere. By understanding that why, You can also recognize the point in your financial journey, should you be so fortunate to reach it, where the variables change, where your problems become so large and complex that you need to add more sophisticated tools to your financial toolbox. For almost everyone watching this, Dave's advice is the gold standard. Buy term life insurance. Get an amount equal to 10 to 12 times your annual income. Get a policy that lasts until your kids are grown, and your nest egg is big enough to stand on its own. And then, invest the difference like your future depends on it. Because it does.